Well, hello. Unfortunately, we don't have any music as we usually do to open up our webinars, but that's because I'm still on location in Stuart's town. It's your new town, Stu, Cape Town.
Yes, Alec, 2 months now. So it's slowly settling in, as they say, but it's a lovely place. And you've been blessed with fantastic weather, I have to say. We haven't had much wind, which is generally our thing that we look out for.
Well, I tell you what, when the Cape Maiden shows her best finery, she's irresistible. And I've thoroughly enjoyed the couple of days here. The budget was fantastic yesterday. It was really interesting. And well, we're going to be talking about, I wrote in the newsletter this morning about a warp speed news cycle. And my goodness, it certainly is. This last night when America went to bed, there was already jitters about what's going on in Ukraine. Then this morning at 6 a.m., Vladimir Putin had a 6 a.m. Russian time, had a broadcast to his people and explaining why he was invading the Ukrainian territory. And now there's stories coming up from all over the place that he's not just gone into the eastern Ukraine, but to other parts. So we'll have to hear and see what he's up to, what everybody else is up to. But if the best pundits in the world who spend their lives trying to analyze Putin are unable to give us any steers on this, I think the story for us is also that we should also not be trying to guess. And that's why I took that Rudyard Kipling quote from his beautiful poem, If you can hold your head when those about you are losing theirs, as the title for today's webinar. But I guess before further ado, Stu, let's get on to the tech.
Yes, thanks, Alec. Just quickly, to those new to the webinars, there is a little control panel on the right-hand side of your screen when you sign in. If you can see a little question mark on that panel, please put your questions in there, and then I'll pass them on to Alec once he's finished with his portfolio. But before that, I almost forgot the sound check. There's also a little high five button on that control panel. If you can hear my voice clearly, I know we had an early problem yesterday with a bit of ropey sound. I think we fixed that now. If you can hear me loud and clear and see Alec and myself and the presentation underneath, please just give me a high five, and then I think we can get cracking. Lovely stuff, Alec. High fives are coming in. No queries on sound, so let's get going.
Brilliant, yeah. And when you watch the YouTube of our budget discussion, the initial minute or so, until we were tipped off that the sound was bad, is not great, but then it gets better after that. Okay, so we got lots to talk about today. As you can see, the WebTrader portfolio, which is now 7 years and 2 months old, has a compound average growth rate of 17.5% in dollars and 22.5% in rands. And it's starting to get more into normal territory now, because if you look over the long term on share investments, they rise between 6 and 7% in real terms. I think we can probably anticipate that could go a little higher than 6 to 7% in this environment, because we do have a massive transformation which is being affected by technology. But at some point we were over 30% compound annual growth rate, and that just wasn't sustainable in the long term. Remember how it works. Compound annual growth rate is that it's the money on the money. So if you put 100 Rand in now, at the end of the year, and you're growing by 10%, it's 110 Rand. The following year, you've got to grow by more than that to actually keep up the compound annual growth rate. In other words, you've got to perform on the money that you're making as well. Anyway, so that's the story, what compound annual growth rate is, and let's get into the portfolio. Stu, I'm quite happy to switch off my my camera.
I think so.
I guess
beautiful broadband as well, internet connection other side. Perfect.
Yeah, our connection's real good here. I'm staying at the Latitude in Sea Point, and it really is a fabulous place. That's our partners, but still, just in case, because there's a heck of a lot to go through. And as Stu said, post your questions and he'll pick them up, and we love this to be an interactive session. That's the big story, and it's all over the news at the moment. It has been all over the news for the last few hours, but certainly it's been the thing that has influenced us in the investment markets for some weeks now. Vladimir Putin is a maverick. He's also, some people say, very scary. They're accusing him of being another Adolf Hitler. He has a different approach to the world than certainly the people in the White House, and he appears to have greater longevity than that. I'm not going to go into anything else because really this is the realm of politics, but the reality is when you invest for the long term, and all kinds of bumps come along the road. You can have July riots in South Africa. You can have a Jacob Zuma plundering the place. You can have Vladimir Putin's troops attacking Ukraine. I'm really not sure what's going on there, excepting to say that Putin reckons that in the eastern part of Ukraine, there is a part that was put into the Ukraine which shouldn't have been there in the first place. It's part of Russia, he says, and in 2014, he annexed part of it in the Crimea, which is, if you've remembered the charge of the Light Brigade, well, they were in the Crimea. And that was the Crimean War between Britain and Russia back then. So he maintains that that's part of Russia. He now maintains certain parts of Ukraine are parts of Russia. The people in that area have been, well, the separatists have actually been ruling a big part of the territory that Putin has now sent his troops into. But the big question mark, and what the Western world is saying, is he going to invade Ukraine generally? It's a very small part that's under dispute at the moment. And in fact, we should recall that, or remember that there's been a war going on there for since 2014. So 14,000 people have been killed in that war between the separatists and the Ukrainian government. But the big question, or the big concern that the Western world has right now, is that Putin will use this as an excuse to attack the whole of Ukraine. And reports are suggesting that could be happening. But again, it could also be that the reports are not properly founded. Where we sit, it's going to be interesting, and we can watch it from the southern tip of Africa. But as far as investing is concerned, whenever there are these kind of ructions, it certainly does give Mr. Market a fright. And as a consequence of that, we will see the differences or the changes in the value of prices of shares that are determined by Mr. Market. When he's excited, then the prices go up. When he's depressed or concerned, then the prices go down. And your job as an investor is to see through all of this. The stock market rewards you for being able to see past the emotion that happens from time to time. In fact, the best investors are those who acquire stocks after they've thought them through very carefully, keep a watching brief on them, but actually don't watch the stock market and watch the way that the market is vacillating, because that can bring up emotions. And if you're unemotional, that will turn you into a far better investor. Of course, every day there is a news cycle, and every day the media want to tell you about reasons why one share went up and another share went down. And often they invent, or the pundits invent, reasons for that. The reality is that there are so many different influences that are happening all the time that to try and comprehend them all and then overlay onto that is every kind of pop psychologist you can imagine. There's a thing, for instance, called loss aversion. And loss aversion means that if you buy an asset and the price goes down, you don't want to sell the asset because you don't want to take the loss on that asset. So if you're trading, I guess that's a big issue. If you're investing, it shouldn't be an issue, because as an investor, you make a decision, you make your investment, and you, unless the fundamentals change in that company, you shouldn't be tampering with it. And that's really the difference between an investor or a long-term holder, and a trader or a speculator. And right now, if you can hold your head and not get panicked into selling on the view that you might be able to cut your losses on the one hand, or buy cheaper on the other hand, then you really are trading. You're turning into a trader, and you are taking on a world of traders with massive, massive balance sheets. The only way that you can really beat these guys as a private investor, or the best way to beat them as a private investor, is to do your homework, buy, and just put the shares away in the bottom drawer. You know, I remember some years ago reading Magnus Haystack saying that you can't time markets, and you really just need to be buying, making your investments and not worrying about it, but understanding why you make those long-term investments. And I thought, no, Magnus, of course you can time markets. Look at 1987 crash. Look at what happened with the dot-com bubble bursting in the early 2000s. But actually, as I've observed these things more carefully over the years, I understand and appreciate that he was 100% right. Because if you'd got real clever and you'd sold Amazon just before it collapsed in January 2000, when the dot-com bubble burst, you'd be very clever for all of about 9 months. Or sorry, that would have been a little longer than that. But it took a little longer than that. But if you had not bought back into Amazon, and had a look at it again 10 years later, you'd be kicking yourself, because the long-term trend was very much intact, even though the share price went down, I think, 97% in that crash of the bubble. So that's what you paid for. That's why you're rewarded as an equity investor. You're rewarded not because you're so damn clever at being able to time markets or buy and sell at the right time, or to find the right stocks or better stocks than anyone else. You're rewarded for being able to keep your emotions under control. And right now, there's that is required probably more than anything else. Remember, one other issue in all of this is that if you're going to panic, then you better be the first person to panic. And the chances of you as a private citizen being the first person to panic are very, very slim, because the traders are panicking, or would have panicked long before you have. So it's in this way, your advantage is keeping your emotions under control and just watching from the sidelines. Make your investments, put them away. Don't worry if they're going up or down on a daily basis. But if you try and trade, you really are looking for trouble. So let's move on to what happened recently in the last year. The Nasdaq Composite, now, as you can see, it had an awful start to the year, but then again, it had an incredible 2021. So it's come all the way back to where we began January 2021. And you can see that the decline in the Nasdaq, which is where we focused, and the reason why we focus there is because we focus this portfolio on exponential companies. The reason we focus on exponential companies is that as the world is transforming, you have got a far better chance of growing your wealth and growing your capital by investing it in a company that is a beneficiary of, to use the hackneyed term now, the fourth industrial revolution, but this move into a new age. And it truly is. You only have to look around you to know that that is the reality of the world we're living in. The internet is changing so much, and there are many other ways that technology is transforming our lives. Just this webinar should be enough to tell you. We would ordinarily have to be sitting in a big room, but here we are. I'm sitting in Cape Town, and you are wherever you might be in the world, and there are people from all over the world who are attending this webinar. So that gives you the understanding that the world is definitely changing. And so if you're going to be betting on the change, on those companies that are going to benefit from those changes, then you have to look for the exponential companies. In other words, the companies that are growing rapidly, and those companies are technology-based companies, and hence most of them are listed on the Nasdaq. So I look at the Nasdaq as my proxy for what's going on, and as you can see, the Nasdaq has been under pressure, significant pressure, and given up all the gains of the past year in the past couple of months. It's hammered our portfolio. It's in the past month in in particular. In fact, a month ago was just about the cusp of when shares started dropping sharply. The good news, and there is always good news in this, is that we are heavily weighted towards Amazon, Apple, and Microsoft. Between the three of them, they're 60% of our portfolio. On the bad news is that we were hit by a couple of other things in this period. Wilson Bailey and Avenge, I'm going to discuss in more detail as we go through. Then 2U's results came out, which were pretty solid. Then the financial director gave guidance or suggestions of what was going to happen into the future, which was not up to what the market, in inverted commas, had been anticipating. And as a consequence of that, look at that smash. It got smashed. It got completely smashed, almost like a company, you would imagine a company that was going bankrupt. But the problem there is that 2U is, it's not going bankrupt, by the way. It's got lots of money in the bank and it's got lovely assets as well. In fact, it just bought a business for $800 million. It's now sitting with a market capitalization of $727 million. I mean, that kind of puts it in perspective, doesn't it? It's been a crazy, crazy time. The Purple Capital has reversed dramatically in the past month as well. Last month, it was our big winner, now down 31% in the past month, or since our last webinar. We will have Charles Savage from Purple Capital at our conference. He's going to be giving a presentation. We'll hear if there's anything that we need to really worry about. I somehow doubt it, but well, we'll be getting an update on that. Purple is still doing pretty well in our portfolio, and that's what happens. You get when some stocks go up 200%, you think to yourself, oh yeah, it's going to go up another 200%. Well, if you look at it in the cold light of day, if you consider Purple's performance, and I'll just put that onto the next slide. There it is there. It's given us a 79% return. My goodness, if you could have bought that 79% return in a short period of time, you'd have been very happy. As far as the rest are concerned, in the past month, Netflix, we bought more Netflix exactly a month ago, just before the results came out, that were very unimpressed by Mr. Market. Again, nothing to do with the way that they performed, but a lot to do with the anticipation of the next quarter. Remember, this is a 5-year project. In fact, the WebTrader portfolio is an even longer term project, because that's been going on now. It's been around now for 7 years and 2 months. But investing is at least a 5-year project, and you're finding these dramatic changes in share prices just based on what's going to happen next quarter. A similar thing with Spotify. Spotify got into a boxing match, well, over Joe Rogan and Neil Young. Neil Young, the musician, not happy at Joe Rogan's, some of the stuff that Joe Rogan was doing. Spotify, certainly the way I read it, has handled the thing brilliantly. But when Mr. Market is in a panicky mood, any excuse will get him to sell you. So that's really what's happened there. It's been a perfect storm for our portfolio. Cornerstones, though, have helped to offset that. If you take those top 4, by the way, it's 70% of our portfolio. So the bulk of this portfolio is invested in stocks that have held their own, although Purple was a big loser in the past month. Amazon and Apple have been incredibly resilient in the last little while. We've also had the Rand, which has done relatively well in the past couple of months as well. In the last month, it's unchanged, and that's primarily because of a decline today after the invasion by Russia into parts of the Ukraine. But the Rand dollar has performed relatively well if you go back over the past few months. There's the drop in the portfolio. You can see we were really riding high a month ago, 11.4 million, recalling that the portfolio started at 2.25 million. It's now down to 15% lower, 9.7 million in US dollars, 15% lower as well. Interesting to see that the S&P 500 index has done better than the NASDAQ, and similarly the JSE All Share Index, which has been buoyed by the commodity boom and very strong commodity stocks who make a big slice of this index. And in fact, the JSE's got, outside of Naspers, which has been a horrible performer, Naspers is down. I was looking at it earlier today. Since we sold it out of the portfolio, it's dropped by a quarter. And outside of Naspers, the JSE All Share Index has got very few. In fact, it's got no top 40. It's got no exponential companies in it at all. So it's very different to what would happen at Nasdaq. And there's the portfolio there. You can have a look on the far right-hand side. There's a very sharp decline, which takes it down to around about October, November 2020, the last time that the portfolio was at these levels in US dollar terms. What we did last month was we bought a chunk. I said we would buy it over 2 months. And this is another issue that we really need to reiterate and to remember. You can't time markets. And when you buy shares, you really are taking a risk on timing. So what we like to do is to buy shares over a period of time. If you can purchase them over 3 months, that's good, especially if you're buying into US dollar shares with rands, because you've got a double hit there. You don't know what the rand's going to do, and you don't know what the share price of the company is going to do. Because this money was already sitting in US dollars, I took a decision last month that both Netflix and Spotify, I think we had 16% of the portfolio in cash, was well worth investing in. And now you can see why long-term investors love share prices falling. Because if you have a look at the top there, we bought last month on the 20th of January, we bought 29 Netflix shares for the same amount, roughly, of what we're now getting 42 shares. So it's the same chunk of money is giving you 42 shares last night versus 29 shares a month ago. And similarly on Spotify, we got 105 shares for the same investment that we did a month ago when we only got 72 shares. So if you're a buyer of stocks, you really like to see share prices fall. And I often defer to pitfalls when he goes through these cycles all the time. Sometimes he looks like a monkey and other times he's a superstar. Right now he's looking like a superstar because he's made some very, very good investments, smart investments over the past few years. But on a 5-year term, he's actually the best performing fund manager in South Africa right now. But he often says that if you had 2 hamburgers available for the price of 1, are you going to complain? Or you're going to have 2 hamburgers? Enjoy it. Warren Buffett also says, be greedy when everybody else is fearful. And of course, be fearful when everyone else is greedy. And that's as a long-term investor, this is a very a much happier situation that in our portfolio, we've got 105 new Spotify shares rather than what our money could only buy 72 a month ago. And that's often the way to have a look at it, unless you're trading. And if you're trading, this is the wrong portfolio for you. There it is in a nutshell. Again, just breaking down the portfolio into its constituents. As I said earlier, 70% of this portfolio is in those top 4 stocks, with purple being 8%. In fact, 80% if you add Netflix. So it's awful to see 2U falling as sharply as it has, but it's only 1% of the portfolio. And similarly, both Avenge and Wilson Bailey, with the shocks that they subjected us to, both of those together are less than 10% of the portfolio. Let's start off with Wilson Bailey. I mean, what a shock that was. There's this stock that we bought. It is the blue chip of South African construction companies, had a fantastic business in Australia that the Chinese made a bid for. The Australian government stepped in and said, no, you can't sell this company. It's a national asset. It's not long ago, a couple of years ago, that this happened. It's a national asset. It's a strategic asset. You cannot sell it. So they chased away the Chinese purchasers, which would have been, with hindsight, brilliant for Wilson Bailey. Then what happens is that very same Australian government puts in restrictions due to COVID, which makes it impossible for Wilson Bailey Homes Australia, which is the biggest construction company, the biggest builder in that country, it's impossible for that company to fulfill its projects profitably. And you know, the Australians, I recall before visiting there many years ago, doing a lot of research and a lot of reading, and I was told that the business in Australia is, I suppose some people will call it highly professional, other people would say less relationship based. But if you go into a business meeting, I was advised, take your lawyer, because whatever it is that you agree upon, you need to put it into a contract. That's just the way that the Americans and the Australians work. I think Americans not quite as much as the Australians, apparently. But in these contracts now that Wilson Bailey's Australian company has been fulfilling, because of the COVID rules, because of everything else that the government has imposed in its nanny state approach, it hasn't been able to fulfill those contracts without losing a lot of money. And those who are on the other side of the contract are maintaining that it's not their problem that the government says because of COVID you can't bring people onto the site, or as many people as you should, or it's not their problem that the supply chains are a mess. It really is a reflection of how politicians and governance can deeply affect investments. And it's made me even more skittish about investing in Australia, especially into physical related Australian companies, because Canberra has the Australian capital, the politicians they put this very good business, which accounted for more than half of Wilson Bailey Group's turnover, into administration. It's gone into provisional liquidation, in other words. They just can't anymore. The South Africans say, we cannot continue to support this business. You might recall they had a big problem in roads that they built in Melbourne. Well, that problem seemed to have been behind them, but with COVID, it's been just impossible for the Australians. So that's what's happened with Wilson Bailey, and the share price taking an awful tumble. An update there is that this morning it's gone back. It got to as low as 75 Rand at one point. It's now trading, I'm just looking at it in front of me, at 83 Rand. So there's a bit of support coming back into the stock. If you look at this from a longer term perspective, what do? Do you panic because everyone else is panic? Obviously not. So we may well sell Wilson Bailey next month, and it might be the right thing to do at that point in time. Certainly the Australian company, its Australian subsidiary being put into administration, was a shock to everybody. If you have a look at the graphs, there was no indication that this was going to happen. The volumes in the trade were in the shares were solid. You can see the share price did the volumes did not pick up. And you look at the share price, there was very little indication from the share price that anything was wrong until that huge plunge. And in a way, I suppose you could say to Wilson Bailey, that's at least your governance is right. You aren't letting people, nobody was in on the trick beforehand. But it is what it is, and it isn't the time to be doing anything silly now. Don't panic when everybody else is panicking. So it's in the portfolio. We'll take a deep breath and reassess next month. The other one was Avenge, and this was a bigger surprise to me. And the reason why it was a bigger surprise is the results. When I read them and I looked at the detail, they were actually okay. They weren't shooting any lights out, but they weren't any reason to panic. However, this is what made people panic. Avenge is really 4 businesses. It's 2 businesses that are long-term, that they're going to hold for the long-term. McConnell Dowell, which is an Australian business. Yes, I have gone and read a lot about that, especially given what happened to Wilson Bailey. They're not a builder in the way that Wilson Bailey are. They do more specialized projects, and they do it all over Asia. So it seems as though McConnell Dowell, or the subsidiary of Avenge, is okay. They're not shooting any lights out. In fact, the profits, the interim profits, were down, but they're profitable. And then the other part of it is the one that I really like, which is Moormans, which is the mining construction business in Africa. So as long as mining is going well, Moolmans will go well. And although again the profits were down, but these are all COVID-related issues, the company is still doing well. But here is what's booked everybody. Another of their businesses is called Trident Steel, and Trident Steel is non-core, and Trident Steel is, sounds like we had an ambulance going past us. Trident Steel is classified as held for sale. So as a consequence of that, it appeared in this line, and the adjustment on the value of it being held for sale, as you can see, in a year ago, these are the latest figures for the 6 months to the end December. There has been a 467 million reverse on that line, and then that impacts earnings, which went from 645 to 186 because of that reverse, and then earnings, pre-tax earnings, well, maybe go to the after-tax earnings for the period from 438 to 53 million. So that's a heck of a reverse. But the reverse has been caused by Trident Steel. They cannot say with any certainty that it's going to be sold in the next year. And if that's the case, then it can't be classified in accounting rules as held for sale. And as a consequence of that, they had to move it out of this. And as a consequence of moving it out of that, they had to take in depreciation and all kinds of other accounting principles. And that is what impacted the earnings, the bottom line. The bottom line was not affected by bad performance. It was affected by an accounting rule. And if you look at it there, and I put that in here, the bottom line here, operating free cash flow, sure, it wasn't 1.4 billion of a year ago, but that was when they were starting to unwind a lot of stuff, if you recall. They were selling things, and Avenge was actually getting it in a point where it was generating a lot of cash. It's now at a steady state operating cash flow of nearly 500 million. Those operating earnings are down from 280 million to 215 million, and normalized headline earnings are actually up. Net asset value, which is another thing that you can't lie about, that's up by a couple of rand. So I'm not feeling as though anybody needs to panic about Avenge. The share price is sitting today at 18.90 rand as we speak. NAV there of 28.5 rand. You've got to have a question mark over McConnell Dowell, the Australian operation. But from everything we've seen, and when you read the interim results, it is operating profitably and seems to be okay, and it's got a big order book which is growing. Hopefully those orders, unlike Wilson Bailey, can be executed on profitably. Certainly there's nothing in the results to say they can't be. So again, don't panic. There's the portfolio after the purchases of Spotify and Netflix, which I spoke about a little bit earlier, and that gives you the breakdown again. We heavily weighted towards Apple, Amazon, Microsoft, those three. 60% of the portfolio in those three. Add a 10% for Purple and Netflix, and then the rest of them really are just making up the numbers. And that's the BizNews web trader portfolio, which has been going a long time. Now, I know that a lot of the community have been following us on the Shift portfolio, and as I mentioned to you before, it's a $10,000 portfolio. What I've done, and this is my own money, so you can see exactly where I'm invested in this portfolio. We started it off to try and make it available to as many people as possible at $10,000. My view was that if you could spend $3,000 over $3,300 in 3 months, or you could put the $10,000 in each month over 3 months, which is what I've done. So as you can see here, my portfolio here, after buying 3 months ago and then buying a month ago, it's 3 months, 2 months, 1 month. The last month was last night, and my portfolio after an cash investment of $30,000 is now down by $4,000 over that period. So it's aligned with what's been going on the markets. I know that this is a long-term investment. Well, it has to be now, doesn't it, with $4,000 decline? But it really has been becoming a co-owner of shares that I'm very happy over the 5-year term of this portfolio will do well. It's not to say that they aren't going to go down still further from where we are now. Certainly, if things escalate even worse in Europe, who knows where it could all end. But that's, again, why you are rewarded for investing in equities, is because you keep your emotions under control, and it's impossible to time it perfectly. Well, not for some people can, but for most of us it's not possible. But where our advantage comes, as I said earlier, is in actually holding on and not being moved by Mr. Market's vacillations. And there, if you have a look at the portfolio now, after all the purchases have been made, if I were to buy it again today or start again today, clearly it would be, you'd be able to buy the whole portfolio for $4,000 less. And you can see there that the big loser, 2U, it's just like in the other portfolio, 2U, the big loser, Netflix, which was quite badly shaken, as well as Spotify, both down 20%. Zoom and Twitter done even worse, actually. And then Cloudflare, which is really my favorite share in the whole world, and to be down 10% at $91, especially, you might have read on today's newsletter that Microsoft is now pushing people into the cloud. And who owns the cloud security? They're pushing them there for security. And who owns the cloud security? Cloudflare, like 90% of the market. So anyway, it's one of those things that will come back in time, I have no doubt. I'm very happy with the investments that we've made here, and we will continue to monitor them every month. So that's the 10,000 portfolio, the shift portfolio, and the other portfolio is the long-term one, which is the BizNews Share Portfolio. Just to recap on that, the shift portfolio then is down about 12% since we started a couple of months ago in December, and the BizNews Share Portfolio, obviously over a long term, has enjoyed about a 17% growth in compound annual growth rate over those 7 years in US dollars. Stu, I've done a lot of talking.
Thanks, Alec. Always good information. So you spoke about emotion. I know Andrew Rissick from Sable mentioned the emotional cost that many people who immigrate as well with their sort of finances and cash it's quite high. So I suppose it's the same you see now with the markets and where they're heading. So it's always good to try to take it out of the equation, but never easy. Just quickly, Bio wants to know, would you give some thought on Xero? A big drop, any reasoning behind it? She says she needs to leave soon, so it would be nice if you can let her know.
Xero's, it's another one of my favorite shares. We would have had it in the shift portfolio. We can't because it's listed in Australia, and the shift portfolio is only US stocks. I did ask Honor if he could have a look. Is my sound okay, Stu? You can hear me okay?
Yeah, it's coming through clear.
Yep. Okay. I did ask him if he could have a look at putting it into put the ADRs into the portfolio, and I'm not sure if they've done that. I know Shift have increased the size of their portfolio by 300 shares or something, but I thought we had the investments, that final kind of rung of investments now on the Shift portfolio. Let's just let it settle a little bit, but definitely if I could buy more Xeros at this level, I'd be very happy to do that. It's a phenomenal company. Whereas it is from New Zealand, so you get a bit worried about what's happened in the Australian the side of Wilson Bailey, but it's a tech company, and they're moving into the UK. They move here into South Africa. We use the product, and that's often a very good thing. If you just love Coca-Cola and you think it's the best product that as thirst quencher, then it's often not a bad idea, if you think it's that great, to become a co-owner of it. In a similar way, we use Xero in our business, and it's certainly streamlined I mean, Stu, you know that it's streamlined our accounting function massively, and once it's also many times better than what the competition Sage, I think they're called Sage. They used to be anyway, Sage Computing here in South Africa, and then there's the other computing packages, but definitely Xero is on a different level, and as a consequence of that, I use it. I love it. There's nothing on the horizon that looks like it's going to beat it, and it's also not a very high price. I'm just having a look here quickly at the market cap, which is about $14 billion. That's Aussie dollars, 14 billion Aussie dollars, which is probably about 10 billion US. And you can be pretty sure that a little bit like a Slack or a company like that, once it gets to these levels, there's going to be interest from somebody because it is just a phenomenal business.
Thanks, Alec. I know you sold Tongaat out of the portfolio a few months ago, but Robin just wanted to know if you could share your views on the company going forward, if you have any.
Yo, Robin. You know, with both Tongaat and Steinhoff, remember we had Steinhoff in the portfolio going back a long time ago, and then you had the shock in December, and we sold immediately. We sold on the Monday, and that's because there were cockroaches. You have to. It was exactly the same with Tongaat. One doesn't know how many cockroaches are there, and as Warren Buffett says, if you see one cockroach in a kitchen, best you know that it's got its cousins. Its cousins are around the corner. So with Steinhoff, we sold at 6 Rand, which at the time, I think it went up to about 9 Rand immediately afterwards. But of course, as time went on, we know what happened to Steinhoff as more and more of the cockroaches came out. It unfortunately was something similar with Tongaat, and the cockroach there to me was what happened in the July riots. Tongaat has got fantastic assets in theory in the land across the north coast of KwaZulu-Natal. However, the Natal riots, in July riots rather, have put the values of those properties under huge questions. Now, of course, there are brave souls who are developing there. We know a guy called Mark Taylor quite well. We've had a bit to do with him at BizNews, who's developing the Blythesdale estate. So there are those who do see a future, but when you're investing in a company that's already got a lot of problems, and then its major asset is it's been affected in that way, then you really got to think twice. So I guess now, if you own the Tongaat shares, you're taking a bet on that property, the KwaZulu-Natal property, improving again. You're taking a bet on Deloitte paying up for the mistakes that it made, which could also be to Tongaat's benefit. You're also taking a bet on sugar. So, but all round, it was just too complicated for me after the riots, and we just took the view. We had gone in there as a big value situation, and every time I go into value situations, Avenge, Tongaat Hewlett, Wilson Bailey, it just seems as though the value is offered because there's a damn good reason for it. So I don't know. We sold out. I think it's 7 Rand 90, and it's a bit lower than that now. But there are better options. There are better alternatives.
I suppose the principle is human intellect and capital, Alec, and you say those are commodity type companies that go against the value proposition of the exponential portfolio.
Every time we've done it, Stu, we've got a hiding. You know that. Every time we've done, well, not really, because we bought Sasol at 28 and sold at 145. But apart from that, it's when you bet on human ingenuity, when you've got a long-term strategy, when you've got a plan, as this exponential portfolio is, it's a plan. I don't mind looking at Cloudflare falling from $120 to $90. It doesn't bother me because I know the business is as solid as it was at $90 as it was at $120. You understand what the business is about. So that really doesn't worry me at all. But when you are in these, and that's because you're backing human ingenuity, but when you're backing commodity companies, you just don't know what's going to happen tomorrow. Tomorrow you can look like an idiot or you can look like a genius through no decision of your own, just through the fact that you own the stock and that there's been it's like gold. Today gold share owners will be very excited that Putin has actually invaded Ukraine. Now, how perverse is that?
No, for sure. Thanks, Alec. Charles wants to know, would you put another $10,000 in next month to average your cost price?
No, I've averaged it 3 times. I took that decision I would do it over 3 months, and I've done 10, 10, 10. If you have lots of money and you are in a position to do it, then of course, averaging it out. But I'm quite happy now with the exposure that I have. So we've got the portfolio. It's settled down now. From next month, we will talk about the individual holdings.
Thanks, Alec. He also asked, I know you touched on Xero. He wants to know your guide. You mentioned 2U, just your guide on the future of 2U, and obviously at these levels.
2U is owned, is disproportionately heavily invested in by the ARC funds, by Cathy Wood. And Cathy Wood's ARC funds, who were the absolute superstar heroes of the past few years, have been the dogs of the last few months. And as a consequence, when she gets repurchases, when people want to buy, when they want to cash in because they're worried about her story, or maybe just taking profits, which is not a bad idea if you've gone up 170% a year kind of thing, then she has to sell. And when she sells a company like 2U, which, as I said before, it's a small company. I mean, just to give you an example, the market capitalization of 2U is today $727 million. The market capitalization of Apple is $2.6 trillion. The market cap of Netflix is $167 billion. So 2U is a very, very small business and relative, or a very low valued business relative to the others in the portfolio. That's why it was a wild card. It is, however, the market leader in online education. And there are still good value reasons why online education is a boom industry into the long term. Clayton Christensen, who was the late Clayton Christensen, the father of disruption, who was a Harvard Business School professor, was urging Harvard to go online because he said that that's the future. People aren't going to come to campuses and stay. This is long before COVID. So the thesis is right. All that's happened is that 2U has become a little bit too heavily concentrated in volatile portfolios, and hence there were sales. I think you pointed out, Stu, that the CEO of 2U, or maybe it was Manny, it just bought more than $1 million worth of shares at these prices. So if the owners of the company are prepared to put their money where their mouths are, that's another plus factor. It's just one of those that you put it away, forget about it. One day you'll wake up and say, I'm so glad I held on to my 2Us.
A top drawer of the locker room, Alec. Bruce says his question is he will be adding to the portfolio as you've done, but he wants to know, is it not prudent for him to maybe wait a week or two to see if there's any more fallout? I think it goes back to your topic on timing.
You know, the problem we've got with this portfolio is we do it once a month. So I've been thinking now for some weeks, and Stuart will tell you that these things, they cogitate for a long time. But I've been thinking for some time now to move into the 2 best South African stocks, which are Transaction Capital, which I know a heck of a lot more about now than I knew before, especially after doing the research and then interviewing David Hurts, the CEO. I just love that company. And also Capitec, which I've known about for a long time and have never really, it's always felt too expensive for me. But sometimes you've just got to buy into these exponential businesses, and relative to the other banks, Capitec is an exponential business, and just put it away and forget about it. Now, had I done that, instead of going for the value plays with Avenge and Wilson Bailey, I'm sure everybody who follows this portfolio would be feeling a lot happier. Anyway, so we've been thinking about that, but now we've had these shocks on both of those, and you say to yourself, suddenly you're 20% difference. Is it really sensible? And certainly now that the shocks have just happened, that and in Avenge's case, there are very good reasons to suggest that shock was a little overdone. Perhaps I don't know about Wilson Bailey. I haven't had a chance to look at it. It only happened yesterday. But you then have to reassess. But it is the timing of your purchases is an inexact science. If you, for instance, delay your purchase for a week and new inflation figures come out which show that inflation's falling, Putin settles in Ukraine and says, okay, fine, we're just going to help our guys here in the eastern Ukraine. We're not going to turn into full-scale war. You will find that you're going to have to buy the shares at a much higher price. So do your homework, decide on the companies you want to own, try not to overpay for them, give yourself an intrinsic value or a value that you think they're at least worth. And that can be very tricky when you start looking at exponential companies because it just looks too high. But if you look at just our portfolio, which has gone from $200,000 to $600,000 in 7 years at a 17.5% growth rate, it just shows you that 17.5% growth can translate into some significantly different business if you're growing on a compounded basis. So do your numbers, do your analysis, believe your own numbers, believe your homework, and if you're wrong, write down a reason why you bought the share in the first place. And if you're wrong, learn from it. That's what this is all about. Investing is a lifelong excursion. You will keep learning until the day you die or until the day you stop investing, whichever one comes sooner. So to me, trying to time things is just like trading. You're going to get it right sometimes. You're going to get it wrong other times.
Thanks, Alec. I know we spoke about commodities. David just wants to know, is it not time to take out some insurance? He says gold and silver are uncorrelated investments, and in times like these will help protect the portfolio. Would you consider?
And David, if you're an active trader, that's absolutely. But we're not this is not an active trading portfolio. This is a investment portfolio. The average time to hold the shares in this portfolio is forever. That's what the purpose is. Whenever we acquire a stock that we include in these portfolios, the idea is that we're going to hold it until Judgment Day. There does, from time to time, things happen, and that fundamental changes happen in the business, and then you have to reassess. Is Wilson Bailey selling off its Australian or putting its Australian subsidiary into administration a fundamental change? Absolutely. Absolutely it is. So you need to reassess it and say, how is that going to impact this company into the future? And then how are you going to react to it? If it's, to me, having the Australian asset was a very big part of the appeal of Wilson Bailey when we did buy into it. Things have gone pear-shaped there, so we need to reassess. That's a fundamental change. But to go off-piste and then start bringing in commodity shares on the expectation that the commodity prices are going to run and that this is insurance against a continued decline in tech shares at the moment, because the value investors, and there's a lot of them, they've been hurting for a long time. They're in full voice at the moment, and their view is that tech shares or exponential companies' valuations have gone too high. They might be right. They might be right in the short term. But the one thing that we know about innovation is that we underestimate the long-term impact of any transformative technology. We overestimate it always in the short term. So it's possible that some of these stocks have been overestimated with what the company is going to do. But I urge you to just sit down with an Excel spreadsheet and put in a thing when you look at a company like Cloudflare, which is growing at 50%, its revenues at 50% a year. And you put that in over a few years and you see how transformative that is to a business. And it's when you see the figures in black and white that it shocks you and you think, no, this can't be true, can't be possible. But exponential companies have a habit of doing that.
Thanks. I think that goes back to the emotional element. just because it's high, your emotions say you must buy, and if it's low, sell. And you've got to sort of move away and stick to your investment philosophy. And if you believe in what you're investing, it'll work. Whether it does or not, it's your philosophy, so you can live by it.
There's so many wonderful sayings from Benjamin Graham and Warren Buffett, which are good to draw on, especially in times like these when everything's all over the place and you really can get spooked quite easily and you can become emotional. You can say, oh, okay, well, let me take out insurance and we're going to buy some gold. And that is that the market is a voting machine. It's what's in fashion right now, and that will send the share prices or the prices one way or the other. But actually, when you invest, you don't invest in fashion. You invest in value, in facts, in what is the number? It's unsentimental. What is this company going to be worth in future if it continues to grow at the current growth rate? And that's very simply what Buffett says to you is the value of a stock is how much you can get back from it when you purchase it today. And the quicker you can get your money back, then the more appealing the stock is. And that doesn't mean that you go and buy a company that's at a discount of 80% to net asset value. It means you buy a company that's at a discount to its future value based on the rate at which it's now growing.
Lovely, thanks, Alec. Eugene wasn't a, can he acquire SA shares on the Shift app? I'm not sure we can, but I don't know if you know.
No, the Shift app is what Standard Bank have done is they have WebTrader, which is the Standard Bank online stockbroker. It's a full service stockbroker, and that has all the stock markets, or most of the stock markets around the world. And then they also have a South African stockbroking license. Shift, at the moment anyway, I don't know what their plans are for South African shares, but at the moment anyway, they only have US shares. A little bit like the way that Easy Equities started. They started with South African shares, and then they brought in US shares, a few US shares, and then they opened it up, had many more. And now Easy Equities, you can even buy Australian shares on it. With WebTrader, you can buy shares in London, Germany, Netherlands, as well as obviously the United States, and Australia, any market pretty much in the world. But on Shift, at the moment, it's in that area, that period of its evolution. I think the next development for Shift will be fractionals. They have been looking at fractional shares. I know I've spoken to Arno about this and said to him, it's so much better if we can buy, like with Easy Equities, a rand amount of it. And certainly they're looking at it. But where Shift's big advantages, and I've seen this now from personal experience, is once you invest the money there, you can transfer it foreign exchange in an instant, literally an instant. And if you have a look elsewhere, you'll see it takes days and days to get your money back from the other alternatives when you're investing offshore. So that's a huge advantage, and it's much cheaper than the alternatives. And they're using the Standard Bank balance sheet and its forex license for it. But no, you can't buy South African shares as we stand.
Thanks, Alec. The hour always seems to go quicker than normal when we're in this webinar. So we've come to the end. I know we've got to prepare ourselves for our trek up north for the conference next week. So I think we can leave it here.
It's very exciting. Yeah, our BizNews investment conference is going to be particularly interesting this year because we've got investment masterclasses with David Shapiro and Piet Viljoen. We've got Charles Savage there as well. Stafford Marcy is going to be talking us. He talks a hind leg off a donkey at 100 miles an hour anyway, but he's going to be talking to us about cryptocurrencies. So there's a heck of a lot apart from all the other very interesting speakers that we've got on investment that we're going to be talking about in the Berg or learning about. And I hope that people who on this webinar or watching this recording will consider coming to our conference. It's a gathering of the clan. It's a meeting of the tribe. It's a get together of people, globally minded South Africans. And our next one is the end of August, early September. We will be opening bookings for that conference at the end of next week. So when the current BNC3, as we call it, third conference delegates leave, they'll be able to book again, because we were fully booked a month before the conference began. So it's a very, very good idea if you want to come along in August, September, and there we will have, again, a fantastic group of people who share their wisdom with us. Then I would suggest that you get onto the site and do your booking early for the what that'll be the spring conference. Can you believe it? So we're now talking about autumn, and then we'll have spring 2022, and who knows what the portfolios are going to look like in spring. It's 6 months nowadays, feels like 10 years in the past. Time really does things do move at a very rapid pace today. But thanks again, Stu. It's been lovely being with you here in Cape Town, and look forward to flying back to Joburg with you today. And thank you to our community for being on this webinar, and really the message I leave with you is this too shall pass. Just nobody knows what tomorrow will bring, but what we do know is that if you invest in a good company, you're a co-owner of a good company, in the long term you will be rewarded for that.
Excellent, thanks, Alec. And we will get the webinar onto the BizNews TV channel on YouTube as soon as possible. And thanks for joining. Cheers.
Bye-bye.